Hey everybody, welcome to another edition of our Trader User Group Weekly Roundup. This is for the week ending July 17th, 2015. We've had a very interesting week. It was option expiration week. Traditionally in these weeks, assuming there's no major newswire reports, the markets tend to start off rather shallow and then finish in a grind up mode. And that's kind of what we did. Although we had a couple of earnings come out that really moved Nasdaq dramatically. But there are a couple of things that I've been talking about for the past month that are just sending a little bit of a careful warning sign out, and I just want to review these with everybody. What you see on the screen here is the E-mini S&P 500 futures, and I want to step out for just a second here. So what I'm going to do is I'm going to select the monthly chart just to set the context for this update this weekend. As you can see on this monthly chart, what I've done is I've run the Fibonacci's from 2009 March lows, and you can see this is the '07 March highs right here, and then we had the big pullback. But you can see since March, when we were down around 669 in the futures, we've just had this huge move up. 2011 really right in there being the only time frame where we had a serious challenge to this up move. Otherwise, we've been in a very strong move up. Now, what I've done is I plotted the pivot high and the pivot low down here, and you can see, let me just move my screen over a little bit so it'll probably be easy for you to see the whole chart and the key numbers here. So you can see over here, I've got the highs here, all-time highs, 2134, and then the 669 number that we hit. So those are the pivots. Going back to 2009, and then the highs made just a few months ago. So if we look at this, we can see a key number. It's not a traditional fib, but it's one that I use that comes in very often on a very strong market up. Now, this is a monthly chart, but you can see here it's just slightly below 1800 at 1788. And you can see here that this is an area that's suspect to me as we go forward in time. And we have essentially, for 2015, not been able to really get a lot of altitude here, not like the other years, right? I mean, we have been fairly steady for this year. We just cannot seem to break out of this area. So if I highlight 2015, that's 2015 right there, okay? And of course, in the month of February, right there, we were down a little bit. But outside of that, we've been in a very tight range, okay? Now, this could be looked at a couple of different ways. One way we can say we're in a consolidation mode, and then we're going to be able to get some energy, and we're going to be able to get some escape velocity, and then boom, off we go. And then the bears are going to say that because we cannot penetrate this area here and we run out of steam, we're going to give it up and we're going to come back down in this area here, possibly challenging this 1788, let's call it the 1800 level roughly, in this area here. So we've got, and I've seen a number of reports, and I put one out also about 3 months ago that I said the upside is probably about 2% roughly. And then the downside could take us all the way down to this area here, plus 12%, even more to the downside. So that shows me that the risk of a bigger move clearly is to the downside, but we can be in this grinding mode for quite some time. We've been in the grinding mode for almost all of 2015. But what does that mean for us and where we want to trade? Well, let's zoom in a little bit more and I'll show you what is setting up. And then I'm going to take you to a couple of other charts on another package here that I use that just kind of shows us a little bit about the breadth of the current market, which is also a little bit of pause for concern here. So if we look at this chart here, clearly you can see the lines. The blue line here is the all-time highs for the E-minis, and then the green line here is a possible pullback zone. It's a a derivative of the Fibonacci that is a pullback. So if we come into the weekly chart here, let's just zoom in and take it in one more step. You can see again these colored lines, and you can see where everything is kind of lining up right here. And on this weekly chart, you can see that, and I don't have them drawn in, I'm trying to clear the chart for you here. You can see that upsloping channel here, and I'm not drawing it exactly to scale, but you get the idea, where we've really only penetrated at one time right here, and we came very close here, and we're essentially right in the center of this channel here. But what I really want to draw your attention to is the MACD here. You can see this fade here as we're making lower highs going all the way back to 2013, in the summer of 2013 right here. And that suggests that the market is being propped up by some sector rotation. Biotech is one, some in technology, and like this week we've got a huge technology thrust in Nasdaq. I'll show you that in a second. But the overall breadth of the market is not getting stronger. In fact, it's being supported by a smaller group of equities. And traditionally, when we get that, then we've got to be very careful. Unless the other equities start to show some strength, we're going to get weakness, and it's just going to fade into oblivion, and then we're going to really have a nice little pullback here, which would support what these indicators are telling me here on the E-mini S&P 500. Now, if we come into the daily, I'll show you again. There's that blue line that has been the high, defined high for the year. And you can see we actually made it back here in May. And we've just been, as you can see on this daily chart here, we've kind of been sandwiched for, going back to March, really, for a quarter or so. And this would be, I would just put this line in like this right here. You can see that is a key pivot point for us, which is right around 2032, roughly. Okay. And there's the high right there. And we're moving up. But again, you can see the MACD is not in a favorable position. That would suggest, yeah, we may come and take it out, because market makers love to set records. But then we suffer a pullback, and then we end up back into this chop again, or perhaps worse. If we take out 2032, we're going to challenge this area here around 1970 area, roughly. And that'll be another kind of line in the sand for us down here, 1970, 1960. We take that out, then we're going to challenge the prior October lows that we made in 2014. So the higher we go, I'm not seeing this being supported the way it should be by all the stocks in the market. And how can I tell that? Well, let me just show you another screen over here, and let me just adjust my tools here so that I can get a different color on my drawing bar here. And let me just shift this screen over. So let's see here. Here we go, right here. So now you can see right here, I've got on the left-hand side of the screen, you can see right in this area here, I have the chart here that really, let me just blow it up a little bit here. You can see this is the percent of Nasdaq stocks above the 20 EMA right here. Okay. And in looking at this, you can see, I want you to look at the chart down here. This is the Nasdaq, and it is just, it's in this upward mode. But the percent of stocks that are above the 20 exponential moving average are going down as the markets are going up. So that's clearly a divergence that I'm seeing here that, is a little bit troublesome for me. And then the other thing is, if we just kind of, let's go back over here and let's come down and look at the percent of stocks that are, let's go from the 20 EMA to the 50 EMA. And if we look at the 50 EMA stocks, you can see the same thing. We've got the Nasdaq moving up, yet we've got these huge diversions here in these stocks that are above the 50 EMA. Again, this shows that the increase in Nasdaq is being supported by less and less of the stocks underneath, right? And if let's just come down here and look at the S&P over the 20 EMA, which we were just looking at the chart here. Again, the S&P is up like this, but I can draw this line like that, and it shows these percent of stocks over the 20 EMA. It's being supported by less and less. Now, unless we get more stocks over their exponential moving averages, this tells me that the markets are running out of breath. These are called breath indicators only because it measures the strength of the underlying current of the market. And then if we look at the percent of S&P 500 stocks over 50 EMA, it's even a little bit more troublesome here. You can see as the markets move up, we've got that down sloping line there. So going all the way back to Q4 of last year, the markets are supported by less and less and less of underlying stocks. So that tells me that the breadth is not where it should be. Okay, it's not where it should be. So if we come back to the markets over here, let me just bounce back over to the screen over here. If we come back over to the markets here, and this is the daily chart. Now let me put my indicators. I'm going to overlay my technical indicators that I've had on this chart for quite some time. I'll just overlay them, and you can see now it gets a little bit busy here, but you can see if I move this around a little bit, just kind of where we're sitting here. We are in this. We're trying to break out of this very slow down sloping line right here, and it's this channel. Let me just get my pen here colored set so I can draw on this chart here. You can see this down sloping mark here where we just after we made the highs at 21.34 for 2015, but we've got a breakout here and a follow-through day on Friday. So our next key hurdle is 21.22. Which is a prior pivot high. If we take out that prior pivot high, that'll negate this down move, and we'll shift from a very slow grind down where we're making lower highs to more of a steady sideways slash chop market. Now, it seems like we've been in a chop market anyway, only because this movement here from up here down here like that is such a strong move right there. It seems like we're in this upward bias move, but we're not until we take out this key prior pivot high here sitting at 21.22. Okay, this blue line is the opening price for the E-minis for the year. This red line is the high price for the year, 21.34. So if we can take that out, that'll put us back into this steady as she goes chop market, maybe challenging the 21.34. But again, the percent of stocks in the S&P that are over the 50 EMA or right at, as you saw in that prior chart, they're getting weaker and weaker and weaker. So we've got to be very careful here in this market. I mean, we just have to be very careful as we move higher. Now, can it go higher? Sure. Markets can go higher. And we're playing them. The way I've been playing the market for the entire year of 2015 is a steady as she goes consolidation pattern. Now, and the way I've been trading this, I've been running this using primarily SPX. And I've got a couple of different portfolios that I'm trading. One that's over, I would say, about 24% annualized, and the other's about almost slightly under 40% annualized returns. And if you want to see how I'm doing that, you can go take a look at our Iron Condor series and just what I'm doing with Iron Condors, which is a little bit unique. And you can go check that series out. But anyway, this is what we're seeing right now in this market. So we've got this little bit of a breakout. Again, it was option expiry week, but we've had this huge move up off the bottom down here. I mean, folks, just 2 weeks ago, we were under the market year to date was in the red, and now we're in the green. Not by much, but we're in the green a little bit. But we're at the top of this channel, so we have to be very careful. If we come and look at the strong index, the one that really exploded with a couple of earnings, you can see right here that the Nasdaq 100, which is 100 of the largest stocks in Nasdaq, made new highs here at 46.54. And you can see the opening price of Nasdaq for the year at 42.40.25 on this blue line. So we just exploded over the past 2 weeks. Just a very, very strong move up. And you can see where we got this escape velocity because we were held up here in this zone. And then only over the past 2 days, Thursday and Friday, we got that altitude. Now, when I see charts like this, I am not going to come in here and go long. I would fully expect this to weaken a little bit, some profit taken, and find support around the 45.60 area. That would be the favored move. And yeah, we may go up a little bit higher, but even then, I would expect a little bit of a pullback on this market right here. So for those that like to do pairs trades, maybe selling the NQ and going along the E-minis may make some sense. But overall, I look at this market and it's got me a little bit of a pause for concern. Now on this NASDAQ, if we put it on a weekly chart, just to give it some perspective, again, you can see this upsloping channel right here, and just how dramatic this move has been. And we're, we can come up, we're up towards the top part. But again, I'm going to direct your attention down here to the MACD as it starts to taper off. I mean, we're well north of the zero line, so that does show strength. But the Nasdaq 100 futures, the all-time high was at 48.84. So 100 of the largest Nasdaq stocks in the futures here, which is made up of the futures here, we're off the all-time highs here. However, if we look at the Nasdaq composite, which is roughly about 5 or 6, 7,000 of all the stocks, if we look at the Nasdaq composite, we made new all-time highs. The prior all-time high was this green line at 51.32.52, and on this past week we took it out at 52.10.16. So this would suggest some smaller stocks, and maybe just a few of the large stocks really took off. But again, I'll direct your attention down to the MACD. It's getting weaker and weaker as we move up this channel right here. So this tells me that we're going to run into some trouble. But again, the markets can go a lot higher longer than you can hold a short position. But I'm a little bit concerned about it. Okay, we're unless we get some making up to do here, then we're subject to these down moves. And of course, if we look at Russell, which was leading the way or doing very strong, it's nowhere near the highs for 2015. You can see here this red line 1292.30, and the rut right here is not even close. And of course, if we look at the Dow Futures, you can see here on the Dow Futures, again, we've regained the the 50 EMA for all the indexes, but the Dow futures are stuck in this shaded zone right here. And of course, 18,334 is where we are with the Dow futures. In fact, the Dow futures closed, I thought it was ironic, the Dow futures closed right at, um, uh, for the week, they closed right at 18,000. So we're right in this resistance zone here for the Dow futures. Now, one thing that's holding the Dow futures and the industrials, by the way, which is the worst sector for the year, is the transports. If we look at the transports, they're really having a tough go of it. The Dow Jones Transports, here's the chart. If we look at this daily chart of the transports, and let's get it so you can see all the, and this is for 2015, right? You can see right here for 2015, the Dow Jones Transports, the high for the year was made very early in the year. It was made back in February, right there. The opening price for the year was 165.09, 165.60. 9 was the high for the year, so only 60 cents. And then we've spent really the better part of the middle of March on working our way down this trend line right here. And you can see the low for the year was 142.72. That was just made last week. Now we're moving up to challenge this trend line. I would love to see a little bit more participation in the market by having this trend line broken, and then we get some escape velocity up to the 200 EMA that's starting to flatten right here. Notice the 50 and the 200 crossed back in early June to the downside. That would suggest longer term, the transports are going to just stay weak for most of this year unless we can get some escape velocity, which would tend to drag down industrials, and it will also drag down the Dow, which is also holding back the S&P 500. We're in the thick of earnings season right now, and I want to remind everybody that the bar is continually being set lower and lower and lower. And the top line numbers, which you can't engineer, are being reduced, the sales. The bottom line number, earnings per share, can be re-engineered with stock buybacks, acquisitions, a whole number of different things. Dividends, they can be manipulated and engineered. Top line numbers, just gross sales. Acquisitions can do it, which is why we're seeing a lot of acquisitions. We're seeing a lot of corporations reducing their shares afloat by doing stock buybacks, which is about 20% of the annual volume this year anyway with stock buybacks. Corporations are taking advantage of the low interest rates. But that's what we're seeing right now in these markets. So yes, bullish market. We're in the thick of earnings now. We've had some great earnings come out with a few companies in Nasdaq which have just exploded. Google, Netflix, Amazon, we're seeing some of these explode. I know a lot of folks that just trade earnings just got burned on these by doing credit spreads. They just got killed. You got to be careful with earnings. I know a number of studies have been done on earnings. I've seen a number of different ones where it's almost 50-50 whether it goes up or down. Even prior earnings in history, it's very difficult to play. And if you do credit spreads on earnings, all it takes is something like a Google or an Amazon or a Netflix to go crazy to just really hurt your P&L. You got to stay small on those kind of things, and you got to do a whole lot of them to have the winners really overtake the losers. So, but anyway, this is where we are with the indexes. Volatility was relatively flat, but if we look at vol, the July volatility futures is going to expire very soon. But let me just show you. We had this big spike. You can see right here, this is the July futures, which expires early next week. But you can see this big up move here. That was China, and that was Greece. But you can see as quickly as it took it out, the wind just got sucked out of volatility. So we're now down where the VIX finished Friday at 1195. Very low vol, okay? If we go take a look at the VIX, which the vol right now is back in a normalized environment, a term structure that you would say is contango. If we look at the VIX futures right now, you can see um, we're back down on this low support bar right here, very low vol. And if I zoom out on this daily chart, you can see as I take it back in time, you can see that when we get here like this, the odds favor a pop up. We actually came down back in this area here, which was in the summer of 2014. And now we're in the summer of 2015 and we're sitting here. So do not think it can't go lower, because it can. But the odds dramatically favor a move back up to this downsloping trend line right here. Okay. Um, so we need to be careful with vol, especially you credit spread traders out there. With low volatility, the premiums in the option market are not as strong as they were. Um, we were loving this area here. We were taking advantage of the high vol with high premiums, and we were selling them a lot of credit spreads. But right now, you got to be careful. Um, so you don't want to get caught in an inverse situation where you load up on credit spreads right here, and then vol pops up there, and then you're underwater, and it takes you a while to work it out. But nonetheless, this is kind of where we're sitting. And speaking of volatility, this coming Thursday, um, I would highly encourage a lot of you that don't understand volatility very well. I've got a volatility webinar series, and I'm going to add to it this Thursday with another couple hour session. So I would encourage you to check out volatility as well. In fact, on this email that you got to look at this webinar, I'm running an educational special, which you can see all of my educational videos for a very low fee. So check it out. But this is kind of where we're sitting with vol right now. Very low, but experience has told me that when vol gets this low, you got to be careful. We got the breadth of market, the percent of stocks in the S&P and Nasdaq in this negative divergence over the movement of the underlying, which would be Nasdaq and S&P. Got to be careful here, guys. We've got bonds in this counter trend move. One thing I will show you is on the US dollar, we've had a breakout in the dollar. You can see this breakout right here on this daily chart. Right in this area here, we broke out over 97.88. I think the dollar is going to go higher once the monetary policies of the US and Europe continue to diverge. You can see the euro here obviously doing just the opposite. The euro is tapering back off again. We are very close to challenging this key level here with the euro. It's a key pivot point. If we take that out, then we're going to come right back down here to the 1.04 area again. I believe we're going to come back down and possibly go sub parity with the US dollar, maybe later this year or early next year, if they cannot get inflation into the market in Europe. Remember, it's Europe and Draghi, Super Mario, from Mario Draghi running the ECB. It's in their best interest to have a cheap euro. They've got to really get some inflation back into that market or really drive it in there. And the recent reports show inflation is going down, not up, in more of a deflationary kind of thing. So they got to really pump it up. The other thing that we're doing here is gold. If you look at our gold trade, it's coming right down. Our gold market, it's coming right down to the target area that I talked about right here. Right at about 11.15, roughly, just slightly above that psychological barrier of 1100. And it's just doing this 3, 4, 5 Elliott wave pattern, putting us down right here. Now, I had said, do not play gold until we get down to this area here. I think if that purple line is a key, 50% Fibonacci retracement going back almost a decade and a half, 2 decades. So that is a key area there. There's also a natural price level at 1130. and that key fib is at 1133. So we're sitting right on a key support area. I think we may blow through it and then come back up. But once we get down in this area here, then I think gold is going to give us some interesting long opportunities. So we just want to watch that and see this. You know, I've been watching gold. I've been trading silver, selling premiums out of the silver market. You can see silver is also coming down very strong. And I've been trading these, primarily silver with SLV to the downside. And I want to show you a chart here. That is a ratio chart. And let's just step it out a little bit here. This is a ratio chart. Well, let's put it on a weekly basis right here. This is a ratio chart of gold and gold and the SPX, right? Or the spiders. You can see we are down at this the gold has just been such an underperformer, going all the way back to August 2011. And we shorted gold back up in this area here. It's been a good play, but I think this is about run its measure here. And I believe that if we look at this and then flip it around on the other side right here, and if we look at the spiders over the gold, so we'll just kind of flip it around, and let's just come back in here to the daily chart. You can see this area here. As we get higher and higher on this, we are getting this bearish divergence down below, right, on this ratio here. And that, to me, as we're moving higher like that, and this would suggest to me that this is going to pull back, which would suggest that gold is going to get stronger relative to the spiders, or to the S&P 500. So these are just a couple of different ways to look at the charts here. And I wanted to just go through these overviews with you. It's a little bit of a longer session. We've been playing the ag market, had some great trades in that. We've had some great trades in live cattle. The oil market, very quickly, we've been playing oil to the downside. Really great trades on the oil. If I take it into the 120-minute chart, we're still, you can see right here on this 120-minute chart, I was calling a lower point with oil. A lot of our members are following us in oil futures or USO, right in that area there. When we were up in this area here, we were looking at taking shorts. I was calling this at 49, roughly 49.25 is where we'll probably find some support. And you can see we've just been moving right down in that area. Same thing with live cattle. I think we've been trading that to the downside as well. So for those of you that are not members of our group, I'd highly encourage you to. They're getting more ETFs out that follow commodities. It's a good way to mix up your portfolio with commodities and equities, because they seem to be two different worlds, two different universes. The equity markets can be going up, down, commodities up, or vice versa, or the same way. So commodities is a good way to play it. There's some opportunities coming up in nat gas. And I think there's going to be some opportunities also in the metals market, as I suggested. All right, everybody, have a really great weekend. I hope you enjoyed the session. We got this Thursday coming up, volatility. Check us out. Check out our specials. You don't want to miss this volatility session this Thursday. And then the following Thursday, I've got a session on, I think it's part 11. Each session is over an hour and a half of trade adjustments on options. So you ought to check out that series as well. If you want to get all of our series, then there's a special that accompanied this email that took you to this site here that you ought to check out. All right, everybody, have a really great day. Have a great weekend, and I'll see our members this Sunday night in our weekly market watch for the upcoming week. Have a good one, everybody. Ciao.